What's going on, Good Eats family? We're back with another video in the Algorithmic Theory series, episode number 4. I'm fired up for this one, okay, fam? Because I'm going to actually show you how low resistance and high resistance liquidity is ran and actually targeted in the market. I'm going to show you algorithmic signatures. I'm going to break down central bank dealing ranges and Asian ranges. I'm also going to use the narrative in play to show you when the current state of delivery has changed from the buy side to sell side. So without further ado, let's get right into the video. Let's go. All right, we're going to start with our first example here. Very, very simple one. So we have this high, low, lower, high, lower, low. When we go to the buy side, which is at this point where it breaks this is low resistance because we have high, low, lower, high. If this was a high, low, higher high, when we come to the buy side, it would be a more high resistance. Okay? So that's how we look at this. We have high, low, lower high, lower low, run on liquidity, right? What does it do here? Run Sunday low, creates this pattern here that we're looking at, the smart money reversal pattern, run on short-term high, right? Pull back into what? Fair value gap. Gone. Take out the low resistance liquidity. High, low, lower high, low resistance, fair value gap above, all of the things that you need to see in a signature. Now, let's go to the sell side, which is right here. And what you'll see is we have a low, higher low. When we get to the sell side of this delivery, check it out. We actually have a target point because this is low resistance. So just like I said on the sell side, how this is low resistance because it's high, low, lower, high. Well, check this out. This is low, higher, high, higher, low. Break structure. So when we come to the sell side of this delivery, it looks like this. It's easier to run. Why? Because of this low being lower than that one. Had it been like this, what would likely happen is something like that, or it would continue upward. Why? Because it runs liquidity and then shoots up. Those are more high resistance liquidity points. But seeing as this is actually not a high resistance liquidity point, this is actually just your simple low, higher low. On the sell side of delivery, it's a target. It's easy to get intercession trade. You know, this could be a day trade. We're on the 15 doing this, so we'll keep it simple. Let's move forward now, okay? So this entire thing here is a consolidation, but we're intraday trading the consolidation. So this is the overall thing going on here. It creates a support here, which is what? This is a balanced price range. It is also a breaker block, right? And this is where price is holding. So it's an entire little mini consolidation. However, we have sell side delivery, buy side delivery. So on the buy side here, this is a nice little entry. So we have a low, high, higher low, continuation up. Well, how do I get into this entry? Well, if you look at what happened here, this is a low resistance liquidity run, right? We have a high, low, lower high. So when we come down here and fail to trade lower and we displace, we run this low resistance liquidity run. On this pullback, that's simply optimal trade entry into a breaker block. Very simple, guys. Boom. Target this area here. Well, why not here? Why not this balanced price range? Why would you not target the higher, resistance liquidity run? Because at this point, it's already been played on. I'm not looking at it to hold any further. If it does, next thing, then we get into this turtle soup short here. Run on previous day high, aggressive short, and this time here, it pulls back into fair value gap. So okay, so the signature is very simple. A run on previous day high, right? Break internal liquidity. So it's external liquidity ran, internal liquidity ran right here, and pull back into fair value gap, short, down into what? High resistance liquidity one. Why is this high resistance? Like I said before, look at the low here. It's a low, right? This is the low. Makes a lower low and then expands. So without making it look complicated, it's basically this. You see how it ran before it actually displaced? that makes it high resistance. So that's why we would target this on the sell side of the curve. So what I'm showing you with the perspective of narrative is, if you know what side of the curve you're on, you can target the next draw on liquidity. It's actually a weapon. Because if you think about it, you can trade 1 hour candles off the 5 minute. You can trade 4 hour candle closes off the 5 minute. You choose the time frame objective you want to target, and then you trade that objective at the time that you're trading. And understanding a couple other things that I'll share in other episodes will help you understand the time element involved in this. All right, let's move forward. So obviously this here takes care of our algo model 2. Let's go to model 3. One of my most annoying patterns, to be honest. You get this sharp run up, right? And then you just get this sideways upward movement. I don't like this. This is retail. This actually makes me nervous because I feel like it could short at any time. So I just like to wait for the actual displacement to happen, like this. I put the breaker in here, assuming it's going to be a breaker. It's definitely got a fair value gap in it. I let it actually come up to this point, and I wait for time of day. This is London's high. It ran previous day high. It ran the open float. Look at this huge range here. It's just, I couldn't even put the central bank daily range only or the Asian range only. I actually had to put them together and divide it in half to make this open float range. And it's still quite a large range, and they still ran it, pulled back into fair value gap, right? Stayed with the narrative, right? This is all buy side of the curve. All of this buy side of the curve. So with the narrative, runs previous day high, short aggressive below all these lows. So that's the trade. I'll say it again so you guys have it. So it's a pullback into fair value, continuing bullish narrative, on previous day high, day trader objective accomplished. And then what this is right here is a news release, right? Volatility, boom, comes down, total soup short. This is exactly why I don't like this pattern. It happens a lot like this, from news to news, sideways movement news. I like to wait for the market to clear out, and then I will enter on the next signature. But I wanted to show you guys the next signature is a lot easier to deal with, because now we have the framework for our narrative. We have this news run up and this corrective move back down. So we have a displacement, sideways movement, corrective move, and then we get the pullback into fair value gap, breaker block. This is a beautiful short. This is a short, this is a short, this is a short. They're all shorts. Objectives is this fair value gap. They're all shorts. Shorts, shorts, shorts. So it's not just your typical head and shoulders. It's understanding the framework and narrative. Displacement, sideways movement, run a previous day high, corrective move, pull back into fair value gap, breaker block, short, short, short. Target, fair value gap. Failure to run fair value gap, hit your break even. Failure to run fair value gap, hit your break even. This one doesn't fail to hit the fair value gap. Hits it beautifully. I'll take 2 break evens, and I'll take the third trade and just do fine on that. All right, let's move on to the next one. This is kind of similar to the other one where we had the corrective move, but this one has better price action because we have already have the narrative in play of being bullish. So it's easier to say, okay, we have displacement, run on what? Intersection highs. And then we have a sell side of the curve coming in, right? So the signature for this one's very simple. If you want to know how to get into this one, we have this high all the way down this low. This is low resistance right here, right? High, low, lower, high, lower, low. So when it comes to the buy side, this is the market structure shift you want to see. Then it pulls back into fair value gap, institutional order flow, entry drill, buy. What are you targeting? This high. Why? We already came down and rebalanced. So this is all just corrective moves to then come back up and run this high here. It's very simple. So this move here is just the same pattern I've been showing you the whole time. You have a low, and the low that runs it, and that's it. Very simple. It's just when you add more narrative in play, it looks like this, a bigger W. So price is fractal. We all know that. So you have bigger signatures happening at the same time as these lower time frame signatures are happening. But anyways, we get to the sell side, right? And in the sell side, you're looking at this now and understanding, okay, run on previous session high, failure to trade higher. What are we doing here? Waiting for price to get down to a discount. Why? Why aren't we looking for shorts? Signatures aren't being offered. This is just melting down. There's nothing being offered here. This is the central bank dealing range. This is a no trade time for me, unless if it's a rollover, one shot, one kill entry. That's a whole nother video. So right here, we get some price action. What does it do? It runs central bank dealing range low. I like that. It fails to break this high. I like that. That's low resistance, right? Because now we have this kind of pattern going on, right? We have the high, low, lower high, lower low. If we go to the buy side, if we break structure and do something like this, this is exactly what I'm looking for, because then I know that this high right here is low resistance. It's very simple, guys. When you understand that when the narrative is changing its state of delivery, you know what to do. And that's what it did here. It runs these intersection lows, pulls back into a fair value gap with a bullish breaker, and it buys. And the objective is very simple, to run previous day high, and that's what it does. Easy trade, beautiful. All right, let's move on to the last one. Here we are, this last one. So we have this entire thing is actually a big consolidation, right? We have this entire thing going on. Very simply put, what we want to do with these types of situations is understand that at some point the consolidation will break out. And that's what happened here. So we had this right here, Asian range, finally break the lows here. Okay, we broke the lows here. And then after we broke the lows here, we had made a lower high, failure to run higher. So all of this became low resistance. So it's just asking to buy. Run on intersection low, low resistance liquidity here, runs previous day low in London. We have been making higher lows in this consolidation in a premium. This is all what? An accumulation. So the signature is very simple. Boom, right here. Enter off the breaker fair value gap right here. Boom, displace, take out the equal highs, break the consolidation. Now, did I know it was going to go all the way up there? Hell no. But I'll tell you one thing. It don't matter, because I took my trade, and I know why I took my trade, and I know why I got out of my trade. And that's what it's about, fam. Be smart. Learn these signatures. Make your own models. And when you finish watching this video, make sure to drop a like and a comment, and don't forget to subscribe. Let's go.